In this week's episode in Investors Corner, me and Ian are going to talk about fast pounds compared to slow pounds. Now, you're probably thinking, what's that mean? Well, me and Ian will dive into exactly what it means, exactly what the risks are, what the differences are, so you can choose the path that you want to choose. We'll also talk about the stocks and shares market compared to property investing. Again, what the difference is, what the risks, how do you monitor those stocks and shares compared to monitoring property investing? And we'll also highlight 3 areas in the UK. So if you are thinking about property investing, then these 3 areas are worth considering to put your money in. And we'll also go through reasons why these are up and coming areas. So if you're a property investor or an investor, then this is an episode definitely to listen into. Hopefully you'll find some golden nuggets within this episode, and make sure that you subscribe to the Investors Corner podcast.
So Andy, let's talk about slow versus fast pounds.
Okay, I'm interested to see what you've got to say on this.
Yeah, caught you on the spot a little bit there. But so there was a video that I watched recently. I don't know if anyone knows who James Sinclair is, but entrepreneurial guy, the party guy he's known as. And he's very hot on property investing and growing businesses. He does a lot of content marketing. And recently he does something with American Express. So American Express, the Amex guys, they do a lot of stuff around promoting business and entrepreneurial flair. And he does some really cool videos. And there's a video I watched recently, and he was talking about slow pounds versus fast pounds. I thought it was relevant to chat through it on the podcast, and I'll give you an explanation of what it is. So your fast pounds, for anyone that's listening or watching, is effectively your salary or your dividends if you're a business owner, but effectively let's just call it a salary for ease. And they come in fast, and typically we spend them fast, and they pay for the bills, and then you've got a bit of money left over at the end of the month, and you may save it. And that's kind of your fast pounds. So if we were looking at that from a property or from an investing point of view rather than a property investing point of view, then you might have fast investments, which, you know, could be quick turnaround investments where you spot an opportunity to put some money into, I don't know, a business that's going to new start, and you get some high interest rate on it, and then you get it back in 3 months later when they pay you back. You know, you would call that a fast investment. But for the premise of this, fast pounds are your salary. Slow pounds is how you build your wealth. And in the diagram that James talks about, he has where you are today, where you want to get to, how you do that, which in reality is lead generation as a business owner. It's the marketing element of it. And then your investments, and the slow pounds are the investments. And I think if you talk to anyone that's very wealthy or classified as I'm financially free, normally what they would say is, I've got a lot of property that allows me to do that. You don't often hear someone say, I'm financially free because I've been investing in the stock market for the last 20 years. It's not a very common thing, is it? It's more, I'm financially free because I've got 11 properties, or I've got 15 properties, or I started buying properties when I was 20, or whatever it may be. So we call that slow pound investing. So something for people to think about today is your fast pounds. Are your fast pounds coming in fast and going out fast? And how much of it are you allocating into your slow pounds, your wealth and your growth and your assets? And there's been a lot of different podcasters jumping on things like the Diary of a CEO at the moment, talking about finances and talking about being structurally correct. And I think there's even on Netflix, there's a particular chap over in America that comes in and tries to sort of help people from a finance point of view. And most of them are saying you should really be in a position where you're investing 10, 15, ideally 20% of your fast pounds into slow pounds for the principle of this analogy. So let's say someone earns 80 grand a year. They take home 50k, 55k of that. Then in reality, are they investing 11 to 18,000 pounds a year into slow pounds, into investing? You know, and for the people watching and listening, are they doing it? Probably if we were honest with ourselves, we would say we're not.
I'd probably say a high percentage of people aren't doing that.
No.
Because, you know, a lot of people think about the fast pounds, don't they? So, you know, if I've got a spare £1,000, how can I turn that into £3,000 in a couple of months?
Yeah.
Right. Go in with the startup businesses, or, you know, people even with cryptocurrency thinking that they can get a quick win from from that. So quick investments, I think a high majority of people would think that way rather than, right, how can I take this £8,000 over a year and put it into something that I can put it in something for 10 years, 20 years, 30 years.
Because I find the flip to it is if someone is saving, if they're using their fast pounds, and let's say someone's managing to save £500 a month out of their fast pounds, typically what they do is they put it into an accessible savings account.
Yeah.
And then in 6 months' time, they go, right, I've got enough money to pay for my holiday. And then they buy a holiday.
Yeah.
Rather than actually ignoring it and putting £500 into a high interest savings account, even that I've just done it recently with Monzo. I bank with HSBC, and from doing a lot of research into this kind of slow versus fast pounds, I thought, right, now I do need to start putting some cash into another area. So I've actively opened up a bank account with Monzo that I don't have a current account for. Well, I do, but it's a non-valid current account just to get the savings account. And then the interest rate on it is like 4.65%. So the standing order is set up from a HSBC account into that, plus a lump sum at the beginning. So it's not on my radar. When I go into my normal current bankings, I don't even know it's there really. I've almost forgotten about it. And that's my slow pound investment that maybe I'll use to buy property with at some point. But at the moment it's almost compounding to a deposit level, I would say. And I think that's something that people should really think about in terms of how they structure up their wealth for the future. So slow pound investing, fast pounds, something to really think about on this. And like I say, it's something that James Sinclair talks about a lot. I think very good, shrewd businessman. He's kind of bought himself into certain types of businesses, but owns a lot of commercial property and very wealthy guy. And I think it's quite interesting for people on this. Now, on the slow pounds, we obviously talk a lot about investments on this particular podcast, and particularly property. One thing that I was listening to the other day that I thought was really clear and a good way to differentiate the asset class of property investing versus stocks, crypto, Forex, whatever you want to throw the other asset classes into. And they described it like this. When you put your money into the stock market, say, unless you're kind of Warren Buffett that's got so much money in certain stocks that the dividends he receives on those certain stocks that pay dividends out on their profits is of a substantial amount, really it's nothing. If you've got tens of thousands of pounds in the stock market that pays on dividends, it's not enough for you to cash flow your lifestyle for a month or a year. Absolutely not. So when you put money into the stock market, it's tied up. That's the difference, isn't it? It's wrapped up in that with a view that in 10, 15, 20 years time, you can pull it out and it's made more money than what you paid.
Yeah, it's a long-term investment, isn't it? It's a long-term goal.
Long-term tied up money, I would say. Whereas the big difference with property that people don't often think about is there's two income streams. There's two different revenue makers with property, which there isn't really in a lot of the other asset classes. And let's say, for example, you invest in a HMO. With that HMO, let's say you bought the property at £300,000 in a certain area. You spend 50 grand on it on stamp duty tax and kitting it out to be a really fluid HMO for 5 bedrooms, for example. Well, with that HMO, you'd like to think that what you've done in your investment has made it worth something. And then in 10 years' time, the property market naturally means it's going to be worth a lot more. So let's say you make 100 grand in equity over 10 years, 10 grand a year in equity. But what you've also got is you've got fast pounds. You've got rental income as well. And that, as a property, as an asset class, you don't actually have in a lot of the other areas. You don't have the monthly return. So, if you look at the HMO and say the mortgage is £1,500 a month and you've got £2,500 a month's worth of rental income coming in, gross profit, you've got £1,000 a month there. Net profit might be more like 700, 650, but every single month you're making £650 profit. Plus every year your slow pounds, it's growing on average 10 grand. And it's not often explained like that, I don't think, to people that are thinking of getting into property investment.
No, it's not. I mean, obviously, you've got your investors out there that have been doing it for a long time or that have looked into it properly, that are surrounded by people that do this for a living. So they would understand exactly what you've just said. But you've got investors out there that probably want to get into property investing because it's a good investment.
Yeah.
You know, you've got the appreciation on the property, you've got the other income, i.e. renting the property out. It's just that people get scared off by doing it because they don't fully understand what you can do and how you do it.
Yeah.
Because, you know, they might hear stories about investors doing it and they might hear the negative stories, i.e. it costs X amount to run, or you need to do this regulation wise, etc., etc. So they're just like, oh, I'm not too sure about that. When actually, when you speak to the correct people, it's not that hard to do.
No.
And investment wise, it's such a good investment.
Yeah.
Because you are gonna get more money from that investment 10 years down the line. If you don't, then something's gone terribly wrong.
And I think you have to put it in your slow pound pot and say, right, what's the best slow pounds? Because if you want to spend 10 grand on something and try and double it, that's not going to happen in slow pound investing.
No.
Slow pound investing is for the long term game. It's to build your wealth, and it's something to retire on, or something so that you can retire early. I would say if someone lives their life on 100 grand a year salary for most of their career, fast pound only spending, spend what they've got, they don't invest in slow pound investing, they will have a nice life, but they will not be able to retire early. They'll have to work until they're 70 years old, 75 years old, without anything other than the pension they've been paying into to fall back on. Whereas if someone was earning 70 grand a year in dividends or salary, and they were slow pound investing 10, 15, 20% of their salary over that window, there's a very good chance they're retiring at 50, 55. So they're almost buying back 20 years of their life to do as they see fit while they're young, free and able, because they were shrewd with their investing that they did, and because of the way they spent their money or invested their money wisely. And you would look at it and say, well, who's lived the better life? Well, I don't know the answer to that. It depends how you've lived it. But if you look at A versus B, I would say if you're 20 years old, most people would say, yeah, I would love to be able to, be in a position where I can retire at 55, knowing I am set. I'm okay. I've been shrewd in how I've done it. I've lived a nice life, good money.
Yeah.
And I've lived well and I've enjoyed myself. I just haven't been flamboyant with my fast pounds. I've been shrewd with my slow pound investing.
Yeah.
And I think for property, where we look at this and maybe people say, well, you kind of talk about the insecurities of investing in property and the legalities, and wow, I'm buying a property at 350,000 pounds. It's a lot of money. It's not your money.
Yeah.
You're putting 75, 80 grand into it. So an 80 grand investment in the stock market versus a 300,000 pound purchase in the property world is about the same, because your deposit is going to be around the 75 grand mark anyway. So it's a 75 grand investment versus a 75 grand investment. It's easier to invest in the stock market because effectively it's a click of a button, isn't it?
Yeah.
And it's harder to invest in the property market from a time point of view because you have to wait for the legalities, you have to find the right thing. But what people that are a bit insecure about it or a bit more cautious around it should remember, take that to the other end of it. When there's a problem, when there's COVID, when there's a Ukraine war, when there's a market crash, the same applies. Click to exit. Everyone pulls out of the stock market.
Yeah.
If you're the last to do it, you're screwed. You just lost all of your investment. Whereas with property, it's harder to pull out. It's a bigger decision to pull out. And it takes longer to sell a property. Therefore, the market doesn't change as aggressively as the stock market and the cryptos and all the other kind of sort of investment classes. So if you're insecure about investing in property from the go in, think about the go out.
Yeah.
Because it's the most secure, it's the most stable on the go out, which for me is a better way of looking at it.
Yeah, absolutely. I think with the stock market is that, look, we've seen it before. Companies suddenly folding, your money's been put into them, you're getting nothing from that. All your shares are gone. You're losing a lot of money. I think the reason why people do the stock market is because majority of people think that right, if I invest in a small business on the stock market, potentially they might find some miracle pill or something which everyone wants. They're the only company to have found it, and obviouswith with that you'll see massive returns because it's an in-demand product or company. We saw it with Tesla, didn't we, when they first came onto the scene? Then suddenly everyone was talking about the electric cars, and Tesla shares have gone through the roof because of that electric car element. We saw it with COVID, when Pfizer came up with a jab, and then suddenly their shares have increased. So probably people look at that and think, right, if I can just find that one, I'll keep going with it, and potentially I might get massive returns. But
so difficult.
It might not happen, and you might lose everything. So what I would rather do is take my money, put it into something where I know I've got a low risk with it. Because in the 10-year term, at the end of the 10 years, I would have made money on that. And my mind is at rest because I've got no stress.
You're in control more of your investment there as well, because if something breaks, you can fix it. You can drive past and see it. You can communicate with the person that's giving you the liquid returns, which is the monthly rent. You can talk to the tenant. You can see what's going on in equity growth. You can get a realistic valuation done every 24 months to find out how much money your spreadsheet is looking like now. Whereas you take Tesla as an example, Tesla is very much driven by, or the stock market is very much driven by PR and media reporting. And it only takes Elon Musk to go on the Joe Rogan podcast and spark up a spliff and all of their stocks and shares crash, and then he gets stripped off at that particular moment, which is real life. That happened. Or you take Coca-Cola as an example. And do you remember when a year or so ago, I think it might have been the World Cup, but the reporter or the person organising the interview after a Portugal game sat with Ronaldo, put the 2 Coke bottles in front of him, and he was like, nah. And he put the Coke bottles underneath and put water in front of him. The stock market for Coca-Cola within the next 30 minutes went, and that shows that you're a little bit out of control when you're putting that money into the stock market. But whereas with property, the slow pounds are the easy pounds.
And with property, not one single person could potentially influence that whole market like Ronaldo did or Elon Musk. That's one person doing something.
You say mini budget, maybe quasi kamikaze.
Well, yeah,
he had a bit of an influence on things, but that's a very rarity.
Yeah, it's very rarity. But for something like stocks and shares, it takes one person like that to do something within 30 seconds for you to lose a shed load of money if you've got shares in those businesses.
And I think let's talk about that, because you've got that mini budget which caused absolute turmoil. You've got, at the same time, we've just come off the back of COVID. We've got huge inflation because of furlough. So 2 different scenarios. On top of that, you've got the Ukrainian war. You've got 3 absolute grenades on the property market. 12 months rolling, average house prices across the whole of UK are reported to have dropped less than 3% in the last 12 months. Off the back of those 3 grenades. People are like, it's going to fall 25, 30, 40%. 2.6% is dropped. That was the grenade. 3 grenades got thrown at us. And that's what it did. War, quasi kamikaze, furlough, inflation levels, as high as we'd seen for a while. And that was the result of it. So
do you think a lot of people don't get into property because of that negative I mean, we saw those headlines, didn't we? They're going to drop by 30%. We're at the end of the year, you're talking 2.6%. I mean, it's just ridiculous what they say. But it's just the media side of things. And, do you think a lot of people look at that negative media without even talking to anyone and just go, I'm not investing the money. I'm not doing anything. I'm selling up. Do you have conversations with people like that say, I've seen this. I agree with it. I'm gone.
Absolutely. I mean, we're a nation of homeowners. We're property proud. Our home is our castle. We're not a nation typically of renters like, sort of middle Europe or some of the other countries that are out there where people just hop around. We are we put our spade in the ground and this is ours, this is where we are. And people typically upsize and downsize in the town they live in.
Yeah.
You know, I know people that get a nosebleed if they go 5 miles out of their town. That is the nation that we are in. So we want to know what's going on, and we want to know what's going on with the market and the property market, and we're influenced by it as well. And as a result, the media play on that narrative, because in this day and age, everything is clickbait, negative headlines, and it's topical. People want to know about that. If they did a crypto market review, or if they did a review on whiskey bottle investing, you know, whiskey barrel investing, which is a thing, or watch investing, it would not get the mass engagement and watch rate as talking about property, because not a lot of people invest in watches or whiskey barrels, but a lot of people in the UK own a property. So I think they use the narrative, and unfortunately then the whole country kind of is influenced by that, and they look at it sometimes in the wrong way because it's snapshot data that doesn't necessarily apply to themselves. And I just want to talk about some area hotspots as well for people. If you know, if people are watching and listening and thinking, actually these guys is logical what they're saying, it's right what they're saying, and actually you could be in a position at the moment of timing. You know, there will be a steep curve in property prices climbing again within the next 3 years. It just will happen. That's how the cycle of events happen. I don't know what the trigger point will be. Maybe it's an election with a stamp duty holiday or something like that just goes bang and everything rockets again. It just will. So timing wise, maybe, are we at the bottom? Are we going to see another 3% market drop next year? If we do, does that matter? I don't know. Are we going to see interest rates go up or go down? I don't know. At the moment, they're going down. So you could be in a unique position at the moment to kind of take advantage of some timing. With that in mind, I think there's 3 places that I've just pulled out, not at random for this podcast, but with a little bit of micro research. Just 3 places that have been thrown on my radar by investors I talk to, people in investment markets, and just from general kind of information that's kind of falling our way from a select amount of conversations I've had. So I've got Preston, Peterborough, and Swindon as 3 areas for people to think about. They're not markets me and you work in.
Nope.
We haven't worked in them previously. We don't own property in those markets. No. So there's no like...
So good ones to talk about then, yeah?
There's no media narrative here to try and shift people in a certain direction. It's just 3 places that I think are of interest. So if you look at Preston, the average house price is around 170 grand. So if someone's got lower levels of deposit and they're thinking, right, I want an area sort of more northern than the home counties where prices are lower and I can buy a whole property to myself, maybe Preston's an area to think about. Why Preston? There's been about a decade's worth of investment in Manchester. There's been a lot of investment in Liverpool. They're 2 massive cities with massive universities. It's nearly impossible to find a rental property in Manchester, especially from student accommodation. A lot of people are almost flooded, and Preston sits in the middle of the 2. So a lot of people are kind of flooding into Preston as a middle ground to the 2. And if you think, right, I'm going to buy an investment, should I buy it in Liverpool? Should I buy it in Manchester? Well, quite a secure way of looking at that is maybe I'll buy it in the middle. Preston's in the middle. And for average house price of 170, if you were looking at putting 25% deposit down, you could throw 50 grand up there effectively, couldn't you? And say, right, that's not too bad. Whereas 50 grand in this area,
not really getting much.
You're not getting a buy to let, let's be fair. So, you could almost get yourself a 3-bed family home that we talk about up there with a secure tenant in there, thinking that we hope equity growth will take place because of the location that it sits in. So something to think about. Second one is Peterborough. Peterborough's got the funding grant of £4 billion worth of investment for what's called the Level Up funding. And we always talk about council investments and following that, don't we, as well?
Yeah, we do. We've seen it in a number of towns, where we are. As soon as investment goes in there and they start, investing that money that they've got, house prices go up, big players come in company-wise, and it just shoots everything up in the right direction. So as soon as that happens, as soon as you see that, you need to take an interest in it.
Yeah, and this £4 billion is for train station investment, town centre investment, travel and infrastructure investment, and it will only flow into other things as well. But £4 billion is an investment in an area where, if I said to you, go buy a property in Peterborough, it's not a conversation that a lot of people would have had.
Yeah.
So maybe there's an opportunity there. Average house price 250. So it's not sub 200. It's not the 350, 400 that's around here. Feels like a nice middle ground. Like if we were looking at this from a low, medium, and high risk investment sort of strategy, that would be the medium one for me. You know, I think you struggle to lose on that. £4 billion investment on the Level Up Fund, 250 average house price. Boom, let's look at that as an opportunity. And the next one, we spoke about this before actually on the podcast, and we had the two guys come on that are kind of property experts in the area, but it's Swindon. And I just thought I'd throw one in that's closer to us, because Swindon's an hour away from us effectively. It's, you know, you can get on the train 20, 25 minutes to Reading. It's the end of the Elizabeth line now as well, since that's popped out. So although it's a slow train into London, it's a nice train into London. It's an easy route. It's easy accessible. Average house price in Swindon is about 300k at the moment. There is 2 splits of Swindon. The new build stuff, which has been built within the last 2 or 3, 4 years. And then you've got all the older style stuff as well in the town centre. And the new build stuff on the outskirts has got a lot of new superstores, it's got new schools. So it's almost like Swindon is like 2 halves of the town, very similar to Bracknell around here that we see. And that normally means that you pull in a lot of people, like newer family, newer welfare areas, into the new build stuff that take advantage. And then as a result, that just improves the economy in the central area, which is maybe a bit older and a bit tired. And 300 grand for 30 minutes outside of Reading, typically, hour and a half easy into London. You could go quicker if you went straight to Reading, got the Paddington line. You can be there within an hour, within 55 minutes. That seems like a sensible area that's now becoming a very family-centric location as well.
I think people forget how close other areas can be. So like, you know, where we are, just outside of London, you know, could probably get into Twickenham, Richmond, you know, all of those places within half an hour down the M3. But if I look up there, I'm paying double, triple what I pay here for the property that I've currently got. And we're talking half an hour away. So I think people forget just that, you know, these locations like this where there's investment still going into it. You know, you've got house builders in Swindon, you've got some big companies in Swindon, you've got big build to rent people going into Swindon as well. I remember dealing with, you know, a 400 unit site, a 70 unit site, a 60 unit site, all build to rent stuff. So they wouldn't be doing that.
They know something.
For no reason. They know something. They're looking at stats, they're analysing. And they wouldn't do that unless it was an area where you're going to get a lot of demand for it, or an area that really they wouldn't go into that area if there's not a lot going on.
We said the same thing with things like, you know, Waitrose and Tesco superstores. You know,
they're not stupid, are they? They're going in there for a reason.
They're doing their research.
Not going there to make a loss. They're going in there to make some serious money because they can. Because I think you've said it before. They look at the average salaries in that area. They look at the, you know, type of families that are in that area or professionals that are in that area. They look at the surroundings. They wouldn't go in there.
The data that is available for these people is unbelievable. I mean, if we can get an area, we could go right to Swindon. What does Experian data show us in it, and actually get the 10% most likely people that are going to move because they've got big gaps in their bills versus their salary. We can get that information as kind of standard letting and sales estate agents. So if we can get that at the click of a button and say they're the 10% most likely people to move based on our narrative, then obviously they're doing their relevant research, and these are the people that have got excess cash to spend in a Waitrose rather than in a Lidl, for example. So they know what they're doing, and I think it's a podcast today to really get people thinking about the slow pound investing, the double returns that come from property, why one of those is liquid, one of those is equity. Whereas if you compare it to a stock market investment, it's tied up. It's quick to go in, it's quick to go out. Whereas with property, it's slower to go in and it's slower to go out, making it more secure if there is some more grenades thrown on the investment fire. And then there are 3 spotlight areas that we'd be really interested to hear from the listeners and the watchers. What do you think of those areas? Are they something that you're going to go and fact find on, do some research on? Do you want us to do some specific area spotlights on those? We've done Swindon. You can find that podcast if you go back God knows how many it is now,
Yeah.
probably 25, 30 podcasts, but you'll see Swindon investing as an area. But, you know, Preston and Peterborough, if you want us to go and do some fact finding, get some local experts in for those, then we can obviously set that up. We can make anything happen.
We can.
Anything happen. And I think it's just an interesting podcast as we now get towards the end of the year. We're going to have mortgage reviews, HMO reviews, buy-to-let reviews, stock market reviews. We've got experts coming on the podcast now for all of the kind of 2023 wrap-ups, and the 2024 predictions will be the next set of weeks worth of podcasts. So if you haven't subscribed and you want the notifications to those, hit that button, make it happen, and we will bring those all to you. And thank you to our community for listening and watching as always.
Why have we made the Investors Corner podcast, Ian?
I think online at the moment there is just way too much noise, waffle and nonsense. Everyone's got an agenda. So the goal was to make a podcast for people that want to invest money in property or other areas where there's no waffle, there's no nonsense, there's no agenda. It's opinion led, but it's an honest opinion. And it might not be the right answer, but we're going to share it.
So on the podcast, we're going to supply people with access to mortgage brokers, financial advisors, planning experts, development consultants, everything around the property industry and the wider fields.
Yeah, so if you're looking at investing in the future, you know that just having an income from your employer or from your business is not enough to give you the life that you want down the line. We're going to hopefully give you some of those answers that will give you the solutions you need for the future.
So please hit the subscribe button. The more subscribers we get, the better guests that we can get on, and the more people that we can reach. So hit subscribe.